Hi everyone. Today we are talking about if your fixed rate is coming off, your bank has no loyalty to you, and we'll be talking about what you need to do next. So, talking about the fixed rate over the last few years, we've had access to a lot of cheap money. And at one point in time, actually May 2021, the short-term fixed rates were as low as 1.95%. And I remember some of our clients actually fixed at 1.98 or 1.99 or anywhere from 3 to 4 years, but others fixed their rates for 2 years. And those are the clients that we have that are coming off, or people that are coming off those fixed rates right now. Just want to add, there's an estimate anywhere around 800 to 880,000 loans that are coming off in 2023, and around maybe 35 to 40% will come off by mid this year. So people took advantage of the opportunity, and there was a reason. And how did lenders end up with such low rates anyway? Where did this cheap money come from, right? Like when the pandemic started, RBA actually offered some temporary funding facility to banks where they offered really low cost 3-year loans to banks to keep the economy afloat. So the banks had access to this really cheap money, which they were able to lend on to borrowers. And according to CoreLogic, between January 2020 and October 2021, about 1.2 million home loans were actually financed based on ABS data. So there was a lot of funding that happened, and all of it was quite cheap. But obviously, we are past that phase, and RBA is wanting to rein in the surplus that people have to control inflation. See, there's never been massive talk of fixed rates in history in the past like it has this time. And there's a couple of things that you need to be aware of if you are fixed and you are rolling off to variable rate. There's two things. The first is loan sizes grew during the boom. As we all know, property prices increased significantly. But if you say bought a property just pre-boom circa 2020, your loan on a variable rate would be significantly smaller than what it would be with the boom, right? When you paid much higher for the same property. The challenge is not only the values grew and the loan sizes grew, the variable rates have also grown, right? We had 10 straight interest rate rises by the Reserve Bank. And what that means is what you'll be paying in interest on the purchases over the last couple of years would be significantly higher than it would have been if you had done the purchase in 2020 or before that. So it wasn't really felt, the pinch of paying so much higher due to the demand, it wasn't really felt by people because their loans were fixed and borrowers were actually locked in at such great rates, right? We've seen as low as 1.89% for owner occupiers and around 2.49 for investment interest only lending, like never heard of, but it is going to be felt now. And I'll just share my screen with some figures around what it might look like on an 800K property. So talking about this 800K property, so say you had a fixed rate in April 2021 of 1.98%. So your repayment for that would have been about $2,949 calculated over a 30-year term. And then we have the current variable rates, which might be around 5.74% for an owner-occupied principal interest loan. So if you are reverting to 5.74, then your repayments would go up by $1,700, approximately $1,700 to $4,664. So obviously, we've assumed here that the bank actually gives you the revert rate, the rate that they're offering to their new customers. But we'll come to that in a moment, speaking about revert rate, because in many instances, you'd be actually be rolling off on a much higher interest rate unless you actually negotiate with the bank. And I'd also like to add actually a conversation that I was having with my relationship managers just yesterday, where his view was that there will be some out of cycle rate rises that banks will pass on to customers. That's, independent of RBA raising rates. So there is a chance that the banks will raise rate because there's so many funding pressures in the borrowings that banks are making to on-lend the money. So there will be further rate rises than just RBA rate rises. I guess from there on, obviously we looked at the payments will go up by $1,700 in this scenario. So obviously calculated, which is significant, which is about like $438 a week. That's like renting maybe a unit somewhere like western suburbs of Sydney, or even in not even that's even getting tighter. So that's like, maybe back in like a few years ago, it might have been another mortgage effectively, possibly. Obviously, if there's cost of pressures on living with inflation, you have to manage not only increased expenses, you have to manage your increased mortgage repayments at the same time. I know every dollar counts for most families, so you have to cut off on discretionary spending like eating out or entertainment, leisure
leisure activity. So there would be cuts, but that's what the RBA actually want. If
Yeah,
you are doing that already, then obviously
it's working.
it's working what the RBA
Yeah.
want you to actually do. Most importantly, from what we are finding is, borrowing capacity has significantly tightened. So obviously the higher the rates, it means that banks are assessing you at a much higher interest rate. So if you're paying, say in this scenario, 5.74%, then the bank is adding 3% on top of your lending. So obviously it could create mortgage prisoners, and you may not be able to refinance for some time.
Yeah, that would be nice to see if that changes, given many people are stuck where they are. And the second thing that we need to be mindful of is most people don't know what their variable rate would be once the fixed term is over, comes off. And banks, they're in a business of making money. They would never pick up the phone and say, hey, John, you're coming off fixed, but we're giving you this discount on your variable rate. Or they won't, even if you're on variable, the banks never reprice your loan. So what you need to know in the background, many banks have what's called pricing tools, which can be used to seek discounts on your interest rate. So if your loan is fixed, there's a chance the banks haven't given you any revert rate on their pricing tool. And what that might mean is when your fix comes off, you roll over on a much higher interest rate. We also need to be mindful that some banks actually don't have revert rate. So if your fixed rate was coming off end of May, you might end up on something like 8%, just throwing that number out there based on what their advertised standard variable rate might be. Often this happens with maybe the big four banks as well, but even probably smaller lenders, right? If there's no revert rate pricing at the time you fixed the loan, you don't know what you might end up on. And therefore, most people are not aware what their variable rate would be. And you really need to be on the front foot to be managing that.
Because I saw one fixed rate for an investment interest only lending that came off from, I think, mid twos it was fixed in. It came off, and the bank actually gave this borrower 6.74% interest only rate, whereas the bank is actually offering new customers rates in the low sixes. So obviously we go to banks for our clients to seek pricing time to time to see if we are able to negotiate their revert rate, to give us an indication what our client will roll on to once the fixed rate comes off. Obviously it will depend on what the variable rate is at the time, but at least we have a good indication of where things are at for this particular client in comparison to other lenders. So obviously that's not applicable to all banks because each bank works differently, but there are some banks where we are able to estimate that. For example, I have a client who's rolling off fixed in end of June, and we know that his owner-occupied principal interest rate would be in the low sixes, whereas other lenders may be offering in 0.5% cheaper for the same sort of lending. But unfortunately, the bank has they're not giving any more discounts, and that's something to be mindful actually of. Even if you negotiate your revert rate, or we do that for our clients, the banks are going to be providing less and less of these discounts. There'll be less retention pricing, really. The banks may not want to retain you because some banks have made a decision. Like I was speaking to one of the banks yesterday, they've made a decision that they're happy with lending they have or the clients they have at this point in time, and they may not be giving more discounts. If you want to move on to another bank, they're fine with it. So
But see, that's why the revert rate is so important, right? If you hadn't negotiated it, and there was a period when banks were aggressively giving these discounts, so even if you were fixed, you could have gotten a much better discount, say 3 months ago, than you would today. So that's why it's very important to keep on top of this, because there's a chance if you can't refinance, you're stuck with a poorer discount, so to speak. So there's a few things that you can do.
sorry,
right?
I'd actually
Yeah.
add one more thing on that. So if you say a few years ago you paid lenders mortgage insurance as well, the banks look at your lending, if you've paid LMI, etc., then they may not have actually negotiated your rate. There are clients where we have asked banks to negotiate their revert rates for what they'll come off as variable, but the bank knocked back and said, we are not going to provide any more discounts for this particular client. In those instances, we are obviously exploring if there's other alternatives for these clients to move on to other lenders, obviously subject to their whole big picture and their strategy, because the values have risen, right, over the last few years. So there is a chance that the loan to value ratio would have fallen below 80. So they don't need to pay lender's mortgage insurance all over again. So there might be opportunities like that if your bank is not budging on this.
Yep.
So I guess there are some things, right, that you need to be mindful of or do as you get closer to your fixed rate rolling off. Firstly, obviously know your fixed rate expiry date. You can obviously hop onto your online banking, internet banking, and have a look at when your loan is rolling off. Call your lender, ask them the revert rate, see what your revert rate discount is negotiated at. What will you be rolling off? Like what is going to be your rate once you roll off, once the fixed term is over? And again, as Sana said earlier, depending on the lender, you might actually end up paying the standard variable advertised rate, which is like 8.3% for some lenders. So you need to be mindful of this and ask your lender right about now.
But I think the pain would also be felt where you have borrowed more than 90% of the value of the property, right? If you have capped at, say, 95 LVR and the property value has an increase and that's what you bought at, there's a chance you might have to pay much higher rates anyway. But yes, Mona said, be mindful of your revert rates. Call your lender ASAP. And there's a chance that you will be paying loyalty tax for being an existing customer. So often banks, what they do is they offer cheaper rates to newer customers. And when it's an existing client, end up paying the higher rate to make up for banks attracting newer business at a lower rate that you're rolled onto. So consider if refinancing is an option. We have seen people so loyal to a lender that they would pay maybe $10,000 more in interest.
Yeah, I've had instances where a client could clearly save $7,000 a year in interest, but they actually chose to stick with their existing bank who wouldn't budge on their interest rates. And the sad thing is now lending has tightened and they will not be able to access those lower rates and continue paying $7,000 year on year. $7,000 over, say, even a 25-year loan term. So hypothetically, they had 25-year loan term remaining. That's $175,000 in extra interest that this person will end up paying because they didn't choose to make the move when they actually serviced for that loan a couple of years ago. But I guess, obviously you have to look over the loan term, not just the convenience factor that you have with your current bank. And say you're ready to take action and you're ready to start planning. So you need to start planning well in advance. It takes time because the loan process obviously involves valuations and us seeking pricings from various banks, various lenders, and also with rising interest rates, if RBA keep raising the rate, there is a chance your borrowing capacity will keep tightening as time goes on. So if you do have your fixed rate coming off over the next couple of months, perhaps it's better to lock in the borrowing capacity and start the process already and get the applications in.
Navigating borrowing capacity is important, right? Especially if you're wanting to invest in the future. So not only just the interest rate, you need to look at the equity that's accessible to you, having a plan upfront for your next investment property as part of this process. And you may be just a homeowner and not wanting to do anything, but many of our clients do want to expand and build wealth through property. And that's where making sure you have an upfront plan comes into the picture, making sure the loan structuring is an important part of it. So you're getting the right advice about the right structure from someone geared towards investing rather than just a transactional approach, right? You can just get online rates if rate is all focus you have. So make sure your finance is set up correctly as part of this process as you're doing this cleanup or looking at what your revert rates are. So you pay off your home loan first, not end up paying interest, 7,000 extra interest, like the example that Mona shared, and to save tax and minimize risk as you go along on your journey. And property is only a vehicle to access finance. That way you'll be able to maximize what's really possible for you personally, for you to financially achieve your goals around financial freedom, security, stability, and control in your life.
Yep. So if you're coming off your fixed rate and you are considering your next steps, whether you want to move from one property to the next and the one after that, or just, plan ahead, really, you might have plans of doing something down the track. So you need to start the process of reviewing your loans right now. To get started with the correct structures, save money, stress, you can book a time with Sana and I and our team to have a discussion on what the potential is for you and what you're able to do. Surat will be dropping a link in the comment section. The link is actually meetme.so/property twins. If you'd like to tee up a call, you can use this link to select a suitable time. And we look forward to speaking with you very, very soon.
Yeah. And make sure you manage in advance what you're doing with your fixed rates and upfront plan. So we'll chat with you guys soon. See you then.
Right.
Bye.